Hi, I'm Julie Gravengood, the broker owner for Clarity Realty, and thank you for tuning into this video. Today we're talking about taxes and accounting for realtors. I know that this is something that all of us agents struggle with a little bit because, we're busy. There's a lot of things going on. So I invited my CPA to come and teach a class to us to try to help sort all of that out. I hope that you enjoy it, get a lot of benefit out of it. Of course, this is a class geared towards real estate agents, but I think anyone who is self-employed would benefit from it. If you do benefit from it, man, I would appreciate if you would share it with your friends. If you want to make sure that you get more of our content in the future, please go ahead and subscribe. And of course, if you enjoyed it, or if you have questions, please leave them down in the comments and we will get back in touch with you. Enjoy! So today what we are talking about is accounting and taxes for realtors. We are self-employed people, and so there are some things that are a little bit different for us than there would be as W-2 employees. So we're going to talk about that. And I hope you find it valuable. I hope that it's helpful in just identifying some ways to just keep record. The best way to not miss a deduction is to not lose track of it. I know that seems really elementary, but it's an issue. So we want to give some hints on that, and just to know tax-wise things to be aware of, because you won't keep track of it if you didn't know you were supposed to. So that's kind of our goal for this class. And again, if you have questions as we go, please throw that in the chat. We'd love to hear from you. Okay, so to get us started, first I want to introduce our speaker for today, Tony Momini. He's a CPA MBA, and he is also my CPA. And if I think that says something about him that I would employ him, because I was a CPA myself, so I don't know if anybody else has this experience that when you used to do it, you're maybe a little bit more critical of those giving you service because you know what it's supposed to look like. And Tony's spectacular. If anybody's looking for somebody to help them with their taxes, if you don't have a preparer, he does a fantastic job. I'd highly recommend him. We'll have his contact info here. He went to Grand Valley, majored in accounting, and also got his MBA there. 17 years in public accounting now, married, kids, loves to watch cooking shows. I'm sure he can tell you a little bit more about himself here when I turn it over in a second. As far as me, you'll hear me interjecting. And again, it's because I worked in public accounting only for 6 years. That was when I was right out of college. I was an accounting major at Calvin. And even though I loved it, there was a lot of things about it that I did really love. For me, and this isn't true, this was just like a feeling that I had, is I felt like I was accounting for people who are doing things, which in my mind, doing things was just being an entrepreneur. Instead of being an entrepreneur myself. So real estate really called to me. So in 2004, I left public accounting and my cushy salaried job and went and became a self-employed commissioned salesperson. I started my career at Keller Williams and then started my own brokerage in 2009. We did change the name at some point, and then moved over to Bridge Street, where we are now, 600 Bridge, right across from Bridge Street Market on the west side of Grand Rapids, and love it there. Anybody, if you're ever in the area, please stop by and say hello. We'd love to show you around. We opened a second office 2018 over in Greenville. Jamie Perry is our broker over there, and he does a fantastic job. I have 3 children, 2 boys and a girl, and I love to run. I'm currently training for the Boston Marathon, or trying to at least, so that'll be an exciting time. So at this point, we're going to start talking about the pros and cons of self-employment, and I'm gonna invite Tony to chime in. Are you there, Tony? Yeah, introduce yourself.
Yeah. Hey, Julie, thanks again for the introduction here today. So good morning, everyone. Hopefully you can hear me clearly and things of that nature. I'll try to make sure I'm talking up this morning. I already had my half pot of coffee, so I should be ready to roll. But we'll see. You guys will be the judge of that, I guess. As Julie mentioned, I mean, you guys are self-employed, right? I mean, on the to the good, that means that you can dictate your own hours to a certain degree. You have some control over your own pay. To the bad, as you probably some of you are well aware, the tax man he comes and sometimes yields a big stick, right? So how do we go about keeping those tax bills down for you guys? And as Julie kind of alluded to before, I think the biggest thing that you're going to, if you come out of this meeting and you say to yourself, boy, they really harped on something, it's going to be tracking those expenses. Okay. I mean, we're not worried about the income. Obviously, you're going to get a 1099 or some 1099s that make up your income for the year. That's not the concern. The concern is tracking, coding, and being able to deduct or otherwise write off those qualified business expenses. Okay. And so the first step in the right direction to making sure that you are, tracking those expenses would be, to use one bank account, use one credit card so that, as a business owner, are saying, well, this money came in, this money went out the door for my business. I need to be able to write this off, and so that is the first step in the right direction. Okay. um, and so obviously you have higher costs associated with running this business, and so there's always this question of what is an ordinary and necessary business expense. In general, the IRS defines an ordinary and necessary business expense as those expenses for which are ordinary for your type of business, okay, which would be, I mean, sometimes hard for you to determine as an individual that's trying to do these returns on your own. But in general, I view that the IRS takes a similar view as a reasonable person would take. And so in many, many court cases, they settled on this reasonable test. Okay. And so they literally say in these court cases, would a reasonable person that is familiar with your business seem to agree that these types and amounts of expenses are ordinary, number one, and necessary, number two, for you as an ongoing business. And if the answer is yes, then you're probably in the clear. If the answer is no, then maybe you've got a problem. Okay. And I always come back to this ordinary and necessary, believe it or not, for multiple different types of expenses. And so we'll get into it a little bit later, but the biggest question that I get is, can I deduct mileage? And usually the answer is yes, but more specifically, the answer is yes, but they must be business related, which means they must be ordinary and necessary as it relates to your business, right? So it is kind of important that we cover some of these topics in depth because sometimes determining whether it's ordinary and necessary is important first, before you even are able to talk about whether or not you can take it as a business expense, if that makes sense. um, as we mentioned before, a separate checking for the business or the business activity is pretty crucial. That will allow you to use a piece of software, for instance, to codify or otherwise summarize your business expenses for the year. Which, if you've been in business for longer than a year, you come to find that, listen, could I be doing things like using a piece of software to save me some time, rather than spending all of my time seemingly tracking down some of these things. And so um, we talk about in this slide. This is my favorite picture, because believe it or not, this is sometimes how especially newer small businesses come in. Right? It's the whole idea of don't bring bucks if you want good results. I mean, you've probably experienced this in the past. hey, I'm new, so I don't really know things, like how much or what types of business expenses should I be keeping track of. So sometimes the tendency is, well, I'll just throw it in the box, and then my guy or my gal at the end of the year will help me to figure out whether I get to take this stuff or not. I think we can all agree, listen, with a little bit of pre-planning, like, talking about reasonable, and ordinary and necessary business expenses. Once we talk about those things, it becomes pretty clear whether or not you should be tracking those things, which becomes pretty clear that, listen, we should probably move away from a shoebox really, really quickly here, if we're being honest, right? Um, and while we're on the shoebox, the one thing that I always get questions on is related to things that are harder to get into a piece of tax software. Okay. And so I like to call these things non-cash or split expenses. Okay. And what I mean by those are things like um, mileage for your business, maybe dues for you as the individual, right? Licensing fees, trainings, cell phone, internet. These are all things that we'll call it, before you even set up your business, maybe you had some of these things that you were having to spend out of pocket before, right? But now that you are a business, it becomes critically important for you to have a mechanism to track and to therefore be able to write off things that are, split between you, the individual, and you, the business. And so, I get every single time for a new person, either they ask me about it or I tell them about it. Listen, it's the same things or it's the same types of things that we're talking about every single time. Make sure that you are tracking your mileage in some way, shape, or form, which we'll talk about in a second. Make sure that you're tracking these, I would like to call them split expenses. Think of things like your annual GRAR dues, your licensing fees for renewing licenses or getting a new license, trainings like this. Um, all of that stuff makes it possible for you to conduct your business, and therefore makes these items deductible as a business expense, if that makes sense. Okay. And so then we'll kind of like transition to tax software. To me, tax software is a integral part of your small business. And so, we've got a couple of pieces of software on the screen here. I won't spend a lot of time talking about QuickBooks today, because it's probably, I mean, for every business that signs up for a piece of business software, 5 businesses sign up for QuickBooks, for every one that signs up for every other piece of accounting software, okay, in the United States. So QuickBooks is the 1,000-pound gorilla. They run this place, okay? So what I'm going to talk about are other pieces of software, okay? And that's because there are some other pieces of software out there that I think can save you some time, maybe save you some money, and maybe you'll be more happy with than QuickBooks, especially if you're starting out, okay? And so if you already have QuickBooks, don't get me wrong, as well as I do that once it is working properly, it is a good piece of software. It's just that it takes a lot of time for this piece of software to work properly. So, you have to be able to and be willing to invest some time if you're going to make an investment in a real robust piece of software like QuickBooks Online. Okay. So with that being said, the other piece of software I'd really recommend that you look into, especially if your gross receipts are under 350,000 and you don't need a W-2 personally, and or you don't have any other subcontractors. Okay. If you check yes, like I'm under 350 in gross receipts, you check yes, I don't need a W-2. You check yes, I don't have any other contractors or necessary, we'll call it other auxiliary tax filings like issuing 1099s at the end of the year. Then listen, Wave Accounting is a great program for your business. Potentially, again, If it's disclaimer time, you have to choose the piece of software that's best for you and for your business. I don't get any kickbacks from Wave, so I'm just telling you, it is the easiest piece of software that I've ever seen that somebody can just pick up and run with. And I'm saying, for you guys that don't have an accounting degree and don't want to have an accounting degree, you can pick it up. You can be entering data. You can link it to your bank accounts. You can even invoice out of there if you need to. You can accept payments out of there if you need to. Not that you need to, okay? Because obviously, normally you're working like through a real estate agent, right? Somebody as somebody else is issuing your 1099, so to say. So you don't necessarily need to issue invoices, but I'm mentioning it as an other option. In case you do get into a scenario where you do need to issue invoices, it has that capability for you. You can be up and running. You can have it linked to your bank account. You can be rolling out your accounting in like 30 to 90 minutes, okay? And so this is by far the easiest, most simplistic, but that comes with drawbacks, right? So if you can tell by some of the words that I've already used, the reason why you would maybe go to a QuickBooks instead of going with Wave right off the bat is if you want a piece of software that can grow with you. So if eventually you're going to get your broker's license, so you're going to be the one in charge of having people underneath you, you might want to look into QuickBooks Online. If eventually you're going to break through that 350,000 gross receipts and get a team of something bigger than just yourself, needing to issue payroll, needing to issue 1099s, things of that nature. Again, you're moving to a QuickBooks, you're moving to a more robust and all-encompassing piece of tax software, okay? The thing that I like about QuickBooks is it makes my job easier because me as an accountant, me as a CPA, I can log right into QuickBooks. I can log into your QuickBooks. I can make adjustments on the fly, and then I can give you training right on the fly. As I'm changing a transaction, I can be on the phone with you and I can say, listen, here's what I did. So in the future, please make sure that you're keeping track of your accounting in the same manner. And the other thing that I like about it is, let's say that you say to me, listen, Tony, I'm at a point, I don't want to do this stuff anymore. Again, QuickBooks is the way to go because now you can have somebody just do the QuickBooks for you, just do the accounting for you. And what I like about QuickBooks is its portability. Like, if you want to say it this way, you can fire your accountant and have somebody else take it over really seamlessly. In fact, you're always in the driver's seat as it relates to this, even if you don't want to be in the driver's seat, which is really important. Because, let's just say 2 years down the road, this relationship with your accountant doesn't work out. You just take them off, you deny their access, you give somebody else access. Now you're back up and running, okay? The other things I like about QuickBooks and this MileIQ app is that with QuickBooks, they have a mileage tracker that's integrated within the program. And you can download the QuickBooks app right to your phone. Same with MileIQ. So if you start going more than 5 miles an hour, which for the average person is, probably, they're in a car, but for Julie, maybe she's out running, so this thing drives her crazy. But else it's going over 5 miles an hour, what it does is it pops up on your screen and it says, listen, is this for business? Swipe this way. If it's for personal, swipe this way. And then you have a tracking of your mileage, which can be a huge deduction for you as a business. In fact, I would argue it's probably the largest deduction for realtors. That's why I'm spending so much time talking about it on, just a 1-hour presentation. So anyway, I'll just leave that. If you guys do have any questions about, accounting pieces of software, mileage, etc., that's all stuff that we can deal with at the very end, if that's cool with you guys. Okay.
My MileIQ picks up all the time when I go out on the boat. And that doesn't necessarily apply, but to your point, it does. I don't run more than 5 miles an hour, but but my boat sometimes.
All right. All right. So then, okay. So moving on to calculating taxable income. Okay. And so, obviously, especially for small businesses, think of, again, people that are not yet to that level where you're filing an S corporation. So you're just not to that level quite yet. This should look really familiar from a tax structure standpoint. We start off with your overall income for you personally for the year, right? So we start off with things like wages, interest, dividends, business income, and rental income. We get to take away things like itemized deductions, standard deductions, etc. We also get to take away this newer. This came into place in 2019. This qualified business income deduction, or QBI deduction. This is a newer concept. What it says is, if you're a small business, which they of course define, but I won't define here. If you're watching this and you're finding this to be interesting, you're probably a small business, okay? And probably a qualified small business. So assuming that you do have a qualified small business, to the extent that your small business does have taxable income for the year, you get a 20% reduction of your income before you pay income taxes on your personal return. It's a newer program. It's a good program to reduce taxable income because, again, as you already know, as small business owners, you pay a much higher percentage of taxes than the average taxpayer out there in the taxpaying universe. So this was one of the few things that I can remember in recent history that truly does reduce your business income. Okay. And
Yeah.
so,
Hey, Tony, I think they do list specifically real estate agents as being qualified for that income, that qualified business income deduction, right?
yeah, I mean, so you do for sure, and I mean, there are a few caveats. Okay, your income has to be like, your income overall has to be low, and your business income specifically has to be below thresholds. If they're
Hmm.
above the threshold, then you lose out on this deduction. And I mean, from like, we do hundreds of tax returns every single year. I think on average there's like 7 to 12 personal returns that miss out on this, of the hundreds that qualify for this QBI. So, I mean, it's fairly rare that you would lose out on the QBI deduction, but usually it's tied to you're making too much money as the small business owner. Okay, so if you do lose out on it, in a way, congratulations, I guess, because you're making really good money, if we can say it that way. But I know it is sort of frustrating when you lose out on. I mean, some of these I've seen them. We see them every year. I mean, I've seen them as high as $35,000 to $40,000 off, before you pay tax on that 30,000 to 40,000. I mean, so if you're taking off $30,000 to $40,000 on in that income band, that could be 10 to 15,000 bucks right off the top of your federal return, where before you didn't get any deduction. So, hey, every time they're going to give us a deduction, we're going to take it, right? But I do want to mention that specifically so that, if you guys are trying to do these returns on your own, you make sure that you do get this qualified business income deduction. Okay. All right. And so then from there, we calculate tax, we calculate other tax, such as self-employment tax, which is really the bugaboo. I mean, that's the one that really hurts you real bad as a small business owner. I think some people kind of take for granted the fact that, now as a business owner, if your rate of tax before historically was, let's just say that it was 15% historically before you became a small business owner. Now, just federally, your tax will, for the same amount of income, your tax will now be federally 30% overnight. So, I mean, people kind of take for granted, like, hey, what does this all mean? Why should I be worried about, taking all these deductions, keeping track of them? It seems like a huge headache. And I keep coming back to, your taxes literally doubled from what it was before. the only way for us to avoid that doubling of tax is to write off every single amount that you're entitled to take. We really can't do that unless you're tracking things. Let's move forward together. So, okay. From there you get to deduct things like child tax credits, earned income tax credits, things of that nature. You guys are probably pretty familiar with those things, so we won't spend a lot of time talking about that stuff. But if you do, again, have questions at the end, happy to take those questions at the end. Okay. All right. So then moving on, then calculating your personal income and some highlights. The standard deduction did increase a little bit for inflation from the last year to this year. Child tax credit, which I'm specifically not going to touch right now. So if you guys do have questions about child tax credit and the expansion of child tax credit, we'll talk about it at the end. But we do know the child tax credit was expanded for 2021. You do get a $300 per taxpayer charitable contribution above the line deduction, which is fairly new. That came into place for the 2020 tax year. Of course, you get mortgage interest deduction on your personal return as well on Schedule A. So that those rules haven't changed in the last couple of years as well. You also get a deduction for state and local taxes, but there is an absolute cap on those state and local taxes of $10,000. Okay, which makes it a lot harder for people to itemize than it used to be even a couple of years ago. All right. Alrighty, so then we will move on to estimates, right? So the other most common question that I get is, listen, somebody told me I need to do some estimates, some quarterlies, okay? Do I need to do them? Yes or no? And the answer is always maybe, by the way. I mean, I don't know if you've ever talked to an accountant before, but our favorite answer is maybe. But, all joking aside, the technical answer to your question is, probably you do need to do quarterly estimates, but the answer is more technical than that. Okay. So we'll try to run through it very quickly, but also very accurately. So, if your business, is likely to make money, number one, then you're going to have to pay tax, number two, right? So for sake of talking points, let's just assume that your business makes some money and that your tax rate personally, before you pay any additional self-employment taxes, your personal rate of tax is 15%. If we can just make that assumption, okay? So if we make that assumption, then we can also make another assumption, which is, what is the self-employment tax? The self-employment tax is a flat 15.3%. So now when we're coming to tax time or coming to estimates time, what is a good estimate for what I should be paying in on the federal side? Obviously this does vary, and obviously I do encourage you, this is disclaimer time, right? Disclaimer time says, do consult with your tax preparer, do be more prepared than this. But if we're talking about setting aside money for taxes, it would be a safe assumption to say that, usually you're setting aside between 25 and 40% of your net business income, right? So your net business income, again, to define the definition, is we start with gross income, right? That's the amount that you receive in commission payout. Okay, that's gross. Then we get to write off things like mileage, grower dues, all this stuff, right? Okay. Then what we're left with is net at the bottom, right? So as long as we're talking about the same number, net business income, we want to set aside somewhere between 25 and 40%. The variation on that 25 to 40% is really truly how much that you're earning as a small business person. Again, this does depend on how much from a household income standpoint that you're making. Okay, so don't get me wrong. When I'm talking in generalities, I want to make sure that I'm also covering the specifics. Okay, so if your household income from a joint standpoint is over $125,000, then between 125 and 250 or so, your tax rate is probably solidly in that 15% federal rate. Okay, so 15% over here means that 30% you owe when it comes time to making your estimates, okay? Because you have 15% ordinary income plus 15.3% self-employment tax, mush them together, 30%. Does that all make sense? Okay. So again, I kind of digress there, but on purpose, because I think you can tell that this isn't an easy thing for you to calculate, okay? Because it's not an easy thing for me to calculate. So when somebody calls me or emails me and says, Tony, listen, I made some more money. How much in quarterly estimates do I make? You know what I do? I go to my tax software and I update in my tax software. Okay, your income went up by this much during the year. Okay, what income otherwise went up? Okay, what are the withholdings? Did they go up or down? Da 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 da. Right? Then it spits out an answer for me, and the answer is here are your estimates. Okay, so what I'm trying to say here is on the quarterly estimate side, you really do need to be working with somebody to get your quarterly estimates done accurately, or you have to know exactly where you're going to be from a household income standpoint, and then you need to separately know how much of that is going to be your business net income. Once you know those two things, okay, and that's really what a tax preparer is going to help you to figure out. Then and only then can you know accurately what are my estimates. Okay. So, but now that we know a little bit of background, now we can talk about when you actually need to make these quarterly estimates. Okay.
Hey, Tony.
So, yeah.
Considering how difficult it can be to estimate these things, do you usually recommend people do them based on last year? Or does it depend if you're making more or less than the previous year?
Yes, I mean, yeah. So normally what we do as tax preparers is we even start with last year, right? And so we say things like, okay, last year you were here, and last year, between the W-2s that, you and your spouse had and the business income that you and your spouse had, you were roughly here. Tell me what changed over here on the W-2 bucket. Tell me what changed over here on the business income bucket. Then now we can see an accurate picture, right? So yes, I mean, I think that's probably the only fair way for you to get relatively close. And even then, I mean, honestly, if you're doing this yourself, like relatively close might get you within, $400 or $500, $600. But I think that's really where you want to be, honestly, from a tax standpoint. Okay. So does that answer the question? I mean, I think that's realistically what you would do. But obviously, especially from a business perspective, your income could fluctuate wildly. So really, you do have to like lock down other household income over here, and then try to lock down business net income over here. Then between the two, now you should be able to determine, okay, how much did my income actually fluctuate for the year in bucket A and bucket B? From there, how much do I have to pay towards taxes? Okay.
So if you want to make sure you don't have a penalty, it's 110% of previous year, right? Like I just know even for me, I usually have like this gut feel like, oh, I think I made more this year. Like I'll run reports on my commissions and go, ooh, I'm up. That's great. But I don't necessarily have a good, get down to the 5 cents kind of feel for it.
Yep. And that is one of the automatic ways to avoid a penalty is 110% of previous year's taxes. But for instance, if your income goes down from last year, you might not want to hit 110% of last year's taxes, right? In that case, you would want to hit one of the other qualifiers, which would be, you owe less than $1,000 after you factor in the quarterly estimates that you've been paying accurately as time goes along. That's one of the automatics. Another one of the automatics is that you're within 90% of this year's tax paid in quarterly. Okay. So there's actually 3 different ways that you avoid penalties. Again, the automatic one is what Julie mentioned, the 110% of previous year's taxes. If you just take that number, you throw it in quarterly, you pay the taxes quarterly, you're good to go for another year, even if your income doubles for the year, believe it or not. That doesn't mean that you won't owe money when April 15th comes along. That just means that you won't owe a penalty in addition to owing the money. Does that all make sense where I'm coming from? I hope so, because I don't know if I have a better way to explain it. Then beyond that, there's also two other ways that you can avoid a penalty from a federal standpoint. That is, if you owe less than $1,000 in totality, A, or B, you've paid at least 90% of the current tax in equal payments to the federal government by way of estimated taxes. Okay. Now, I do want to kind of shift gears a little bit and talk about the state of Michigan. I know that a lot of tax practitioners don't get all juiced up about the state of Michigan, okay, as it relates to, I don't know, anything in particular. One of the things that I do or want to make sure that we understand is that the federal government doesn't really hit you up very hard if you miss your quarterly estimates. What I mean by that is their penalty is actually equivalent to about a 1% interest rate on what you otherwise owe. Okay. So another way of saying this is, listen, I know that nobody loves a penalty. Okay. I know. All right. But the other way to look at it is, listen, really what you did is you paid them 1% to not pay them in ordinary payments throughout the year. That's literally what you did. So on the federal side, it's probably not the end of the world if you owe them $1,000 or you owe them $5,000, as long as you saved the money as you were making the money so that you're not surprised by the tax bill, right? I think we can all agree that, okay? So with that as the background, the state of Michigan is actually maybe more important to pay quarterly because where the federal government charges you a 1% penalty, the state of Michigan charges you a 25% penalty. Okay. So if you owe more than $500 to the state of Michigan and you should have been paying your quarterly estimates, they will go ahead and they will calculate your penalty, which is a 25% penalty broken down by quarter for every dollar that you are short $500 or more on the annual return. Okay. So I know that it's a little bit late for 2021, but again, if all we do is we walk out knowing or remembering one thing, it is that number one, you want to be close for how much that you will owe to the federal government. So you set aside enough money for taxes. Okay. And hopefully you're paying that as you go along. Okay. But if you don't pay it as you go along, not the end of the world. The second thing that I would like you to remember is if you owe $500 or more to the state of Michigan, which if you're making business income, you probably will, then you probably need to be paying that amount quarterly. If you don't pay it quarterly, effectively, they're going to charge you a rate of about 6% per quarter for not making that payment quarterly. Okay. And if you don't make the quarterly payment, so be it. Then you just pay the state an effective rate of interest of 25% per year, and you move on to the next year. Okay. And I assume again we're going to have questions about some of this stuff at the end. We'll probably take those questions at the end. All right. So some special rules that we want to make sure we cover. These are again questions that we get on the regular. So gifts are limited to $25 a piece. That is $25 per individual. So if I wanted to give a gift to, we'll call it to Julie for, being a great client and referring us stuff, right? I better make sure that my gift is $25 or less, which is not such a great gift, unfortunately. So sorry, Julie. But that's the bricks if I want to be able to write it off. If I don't care if I need or if I'm able to write it off or not, then I can happily give away gifts that are much more in excess of $25. It just means that I lose out on the ability to deduct these items. Okay. So I just want to make sure that everybody's on the same page as it relates to that.
Hey, Tony, what if it's a $50 thing, but it has my logo on it?
Well, so that's where it becomes more interesting. Okay. So if it has your logo on it and it's considered to be, we will call this a, we talked about this yesterday, I think, Julie, right? Can we call it swag? Can I say that with a straight face? Okay. So you give out an item that you paid more than 25 bucks for, but it's a swag item, right? I mean, think of, what these things are, golf balls, I mean, there's millions of items out there, right? But you put your logo on it and all of a sudden it's swag, right? But you definitely overpaid for the item, because whoever put the logo on it charged you, twice or three times the value of it, because they put your logo on it. I think we all know what swag is. As long as it's swag, then I think you're in the clear. Okay. But if you want to, like, I mean, here's my good example. Okay. If I wanted to buy an expensive bottle of booze, right? An expensive bottle of champagne, an expensive bottle of whiskey, name your poison, pick your poison, right? But I put my logo on it. Does that mean that suddenly I can deduct it? Nope, I'm sorry. That doesn't mean that magically now that you can deduct this thing. Okay, so I just want to make sure that we're all on the same page. If it's like lovingly called swag, you can probably deduct it because realistically the value was inflated because you had to pay somebody to put your logo on it. It's not the value of the underlying item was under $25. Does that make sense? So as long as we're on the same page, I think that's that's kind of the rules related to that. Does that answer your question, Julie?
Yep.
Perfect. All right. So then moving on to cell phone. Cell phone, is a business percentage basis item. So again, you have to be able to prove that it is ordinary and necessary. Number one, and then number two, you have to kind of be able to prove that what is the business use percentage. I know a lot of people struggle with this, and so there are a couple of taxpayer friendly rulings that have come out in the last year. One of them is that if it's more like, how do you want to say this? If you cannot operate your business without the cell phone, number one, and number two, it's reasonable that you are using this 50% or more for your business, then you can deduct the full value of your cell phone expense. So thankfully the IRS has started to realize, listen, we're not going to swim against the stream. Here we're just going to assume that if you, again, it's ordinary and necessary and it's reasonable that you are using this 50% or more, we're just going to give you the deduction for it. Okay. So that's a good piece of news for us as practitioners and for you as people that want to write this stuff off. Club dues are not deductible. For 2021 only, and again, I'm going to say this again, for 2021 only, meals are 100% deductible. Entertainment is still 0% deductible. So again, if you want to buy those, you've got a good client or you've got a good referral source, or you did a closing and it went great, whatever, you want to buy those Griffin's tickets for your person, that would be considered to be entertainment. You cannot deduct that, unfortunately. 0% deductible. So meals in 2022 and going forward are again 50% deductible, where in 2021 only they were 100% deductible. I just kind of want to say that 3 or 4 times just so that everybody's on the same page. Okay. All right. So then we will move on to automobile, I believe, is our next topic there. So we love the automobile. We have a love-hate relationship sort of with the automobile. I think as long as you are tracking the reasonable business expenses for the automobile, then everybody's on the same page. Then you get the deduction for it. So again, we're talking about business mileage. Business mileage are things that are ordinary and necessary for your business. Think of things like driving to a potential listing, driving to an actual listing, taking your clients out to look at houses, Okay. So anyway, for 2021, mileage rate was down a little bit to 56 cents a mile, and then it's back up to 58 and a half. Yes, it does drive me crazy that they have a half cent per mile. It's kind of interesting. This is like, I think they got the idea from gas prices, right? So when you drive by the gas, it's like they give you like 9.9 of a cent. I don't know if they came up with that way, but anyway, it's fun to talk about.
Hey, Tony, sorry to interrupt you, but a couple questions on the chat about the meals. It was 100% 2021, but 2022 is back to 50%. Like that's happening like as of now.
Yes.
What if you give a gift card? Somebody's moving, I'll often give them, $50 to favorite restaurant so that they can, go out to eat while they get settled. That would be 100%.
So it would be 100% as long as it's not otherwise precluded as like, something else. Does that make sense? So again, we're dealing with two different things here, right? So one of the things that we're dealing with are things like, a closing gift becomes a gift at some point. So what is deductible and how much is it deducted, right? Does that make sense? So I hear what you're saying. I think that we just have to make sure that we're understanding it 100% correctly and on the same page. So if you go out to a restaurant and you swipe your debit card or credit card, for the meal that you just ate, that's 50% deductible in 2022. If you go out and you buy some gift cards and you give them out to people, for closing gifts or, just as a thank you, to your referral sources, et cetera, as long as you're not over that de minimis deduction for items, then you're allowed to write it off 100%. Okay. All right. And I know that there's going to be probably a lot of other questions specific. And so
yeah, we'll save them for the end, the rest of them.
Anyway, so probably we'll just take those at the very, very end here, if that's okay.
Yep.
Okay, sweet. All right. So if we can think about it this way, okay, for automobile expenses, you get either a mileage deduction annually or you get actual expenses annually. Okay. And so, in our more advanced class, we get in depth with things like what would be better for you as a business owner? Would it be better for you to take actual expenses and we give you a scenario, or we give you a scenario where it'd be better for you to take mileage? Okay. Unfortunately, especially because we're running out of time, and this is how it goes every single time, right? But by design, Julie. So we're running out of time, but sorted by design. So
I know that's why we have part 2 coming up.
Exactly. So you got to hit us up next time, okay, for part 2. But with that being said, usually for most people, you're heading towards a mileage deduction. I mean, it's a rare case, or more rare now than it used to be. And it's actually related to the efficiency of today's vehicles. Okay. I would argue, unless you have an expensive vehicle, unless you're selling your vehicle or getting rid of it every 2 years, or you're into leasing, if you have one of those 3 things, then maybe you're better off to take actual expenses for your vehicle. If you don't check 1 or 2 of those boxes, then I would say you're probably moving towards taking a mileage deduction annually, just to keep things simple again, to move the discussion forward. All right. And then we do want to mention here that there is still a credit available for, we call these alternative motor vehicles. Most people in the general public call these electric vehicles. All right. But we call them alternative motor vehicles because sometimes they're hybrid electrics. Sometimes they're full on electric vehicles, but there are credits available for new purchases of those types of vehicles. So, you know, the dealerships would be intimately aware and familiar with those things. You would just want to ask them before you buy the vehicle, listen, does this qualify for a tax credit, yes or no? And they would be able to tell you whether or not you qualify for that tax credit, and they should be able to tell you how much. So anyway, you know, it probably is worth a verification piece on that, right? Because I'm not trying to say that they're trying to sell you something, but they're kind of trying to sell you something, right? So anyway, moving on. All right, so we'll move on to business use of the home. I know that we get a ton of questions about business use of the home. And so to keep things simple, again, keep them simple, clean, and easy. You do get, and this is again a recent thing, you know, in 2018, they changed the rules related to this. So you get you're eligible for a flat $5 per square foot, up to a $750 flat deduction annually. If you don't want to prove the business use percentage of your home office, I will mention, just so that we get it out of the way for everybody now, it does have to be a dedicated separate space for the home office. So if you're talking about a home office, it has to be for everyone. I'm talking here. It can't be a nook in your kitchen. It can't be, you know, like half of the basement that's wide open. That doesn't fly. Home office has to be dedicated. It has to be separate. And if you ask the IRS, it has to have a locking door, but it has to be exclusively used for your small business. That means you can't have a pool table in there. That means you can't have the futon in there for when, you know, Aunt Lucy comes over to spend, you know, the night, you know, periodically throughout the year. So again, separate, dedicated, exclusively used for the business. Okay, as long as it's all those things, then you can take either a percentage of your otherwise home expenses, or $5 per foot, you know, to be written off there. So anyway, yeah, I think that is really a good kind of like high level summary of that. All right. So I know we do have a lot of questions.
We do have some questions that are on the chat, and we have a couple minutes, so we might as well go over them. I got a question about the home office, since we were just talking about that. What if you rent an office? This person is saying it. What if I rent an office in town just for customer convenience on top of my home office?
And that's a great question. Okay, so I will say this is a not taxpayer friendly result from the IRS. They say, the IRS says, listen, you have one office that you can deduct. Okay, so if you rent a office, including if you pay your agency a reasonable rental fee, and that is your primary place of conducting business, then you also do not have a home office deduction. Okay, and so the IRS is actually fairly clear and explicit as it relates to this issue. If it really grinds your gears and you really want to have the equivalent of a home office deduction, there's some things that you can possibly do on the backside to try and get an equivalent deduction. Okay, but that's a more advanced related item there, and I really don't want to get into that now, because I don't want there's a lot of, like, how do you want to say it, like, we would have to talk in depth about your specific tax scenario before we determine whether it's even worth it or not, because I think a lot of people get, if I can use the term, bent out of shape related to a home office, especially if they can't take it, because they feel like, well, everybody else is taking it. Well, that might be true, but just to use the what is a write-off, or what is it saving me? If you have a write-off that's $1,000, let's just say, okay, and you're a 30% tax rate, you only save $300. So if it took you, I don't know, 3, 4, 5 hours to collect all this information, and it always saved you $300, I mean, you might be kind of mad about that you wasted all that time. Number one, worrying about it. Number two, collecting it, and number three, trying to make sure that you're entitled to the deduction by doing some exotic things. So again, like, there are some other things you might be able to do if you're otherwise precluded from taking this deduction. But I don't.
Yeah.
Yeah,
So I would, if somebody has an office in their brokerage and they tend to work 80% from home, it's probably best to see if your broker has a drop-in space and let go of your desk. If you're worried about taking the home office deduction, is that a fair summary?
I would say that's pretty fair. Yes. Yep.
So a couple of other questions regarding client gifts, because of course we do this, especially as closing gifts.
Yes.
A couple questions regarding that, and I'll just kind of give them to you both at the same time. One is, is it $25 per person? So if we have a client that is a couple, can we give them a $50 gift? That would be question number one. And then question number two, if it is swag, like for example, I know I give a bottle of wine and then I have like glasses that are etched and like a little wine carrier deal that has some etchings on it so that it's, they remember that, oh, they used Clarity when they bought their house. Would that stuff that has my logo on it, can we call that advertising? So that really what's left for me is the bottle of wine. I mean, maybe we don't want to get too in the weeds of, but just as a general concept,
yeah,
if you bought it as swag, I know you hate that word, but promotional products. So what I got from you saying before, and I just want to make sure if I'm understanding this correctly, if you paid a premium on the product because it's going to put your logo on it,
right,
then we can kind of call it advertising within, as long as it's not excessive.
yes.
You can't buy a diamond ring and put your logo on it.
Exactly. I mean, and that's the problem that you run, right? I mean, like, if we can go to the extreme, you can't buy a car, put your logo on it and give it to somebody, right? And then try to write it off like, oh, this was just a closing gift. I mean, like, nobody buys that. So, that's not a thing. Okay. But like, using your example, Julie, I think that, like, if you are worried about it, literally your accountant would tell you, listen, what we would try to do is we would try to, like, we'll call it separate the price, separate the price or the fair market value from what it costs you to get your logo on it first. Okay. And then we would be able to determine what it is worth in someone else's hands. So another way of saying it is, let's just say in this mythical scenario, right? I mean, I don't know how much stuff costs anymore, by the way, like I'm like an old guy and I'm sort of cheap sometimes, so so let's just
So you
say
can't get around it just by throwing your logo on it. Is that kind of what you're saying?
that's what I'm saying. Okay. But more specifically, what we're talking about here is, let's just say that your wine glasses cost, like, they retail for $15 if you were to buy them at a store. Okay. Let's just say in a hypothetical scenario. But now, because you get your logo etched on them, now they cost $50. Okay. I mean, that seemingly probably happens. I mean, I don't know if that's realistic or not, but either way, if you were following it to a minute detail, you would say, listen, the value of these is actually $15. So I'm adding up the value of the wine glasses and the bottle of wine, as long as it's below. And actually, I personally, as a business owner, I use a higher standard than 25. Honestly, that $25 standard is actually designed to preclude individuals that hire people from giving them gift cards and then just calling it like, well, this is a gift. It's not included in their wage. There's actually a higher standard that's a $75 de minimis standard. And so the $75 de minimis standard says, listen, as a business owner, reasonably, you can deduct items that you, again, have an ordinary and necessary business expense. However, the IRS will, at their discretion, by the way, choose not to audit you as long as they're reasonably below $75 per incident. So this would cover, by the way, your gifts to these home buyers or sellers, if you give them a gift basket. So if you want to use this higher threshold of standard, you can give them a gift that literally didn't cost more than $75 and not have to worry about it as long as it is below, again, the de minimis standard of $75 per incident.
Hey.
And so
I like that.
Is that I think that probably is also a more reasonable standard in today's day and age. I mean, what the hell can you do for $25?
Nothing.
You know what I mean? Like,
nothing that doesn't make you look like a cheapskate.
Yeah, exactly.
Flowers,
yeah.
not even flowers.
Yeah, exactly. My accountant told me that I can only give you this, so sorry.
Exactly. Okay. Well, I think there are some more questions. I think we've at least generally covered most of them, but I'm going to print out the chat and we're going to make sure anything that we left untouched that we either cover the next class or I'll get back with you individually. Or we do have a Facebook page, Training with Clarity Insiders, where I am going to post a list of like deductible things, generally for us realtors, what comes up is things that are deductible, just to help you like check boxes and make sure you're thinking about these things. That will be on there. So go ahead and join that Facebook group. And I'll also make sure if there's some questions that weren't answered on the webinar today that came through the chat, that we'll put some discussions on the Facebook group as well. But most likely, especially if it's covering a broader topic, we're going to pick that back up on our webinar for next month. Again, we're going to be talking about, does it make sense to be an S Corp? What kind of retirement options do we have? A little bit deeper into automotive, and if it makes sense to buy a car or to just take the mileage. Oh yeah, and Cindy asked, are we going to also talk about rental properties? And certainly that'll kind of fall under the umbrella of retirement and investment. Rental properties are probably my very favorite thing in the world to talk about. I'll probably do a webinar just on that in the not too distant future, because man, it's prime time to be doing that. It's such a hedge against inflation, and that's what everybody's talking right now is inflation. Real estate is the answer to that in my mind. So, but anyways, I digress. All that to say, come back next month. Put it on your calendar. Be watching for that email. I will also, post a link on how to register in the Training with Clarity Insiders Facebook group. So be looking for it there. Yeah, as usual. Thank you, Tony. I have a little bit of chatter in the chat also saying thank you. And we will see you next time.
Sounds great, Julie. Thanks again. I really appreciate it.
Yeah, thank you.